Good day. My name is Gwen Baldon from BA164. Our topic for this video is all about how to minimize risk in stock investment. Minimizing risk in stock market, as we all know, every investment has its label of risk and return. And as I have learned from my instructor in my subject FM5 investment portfolio, the higher the potential return on top of the investment, the higher the risk of uncertainty that even the investment, aside from the promised return, will not be recovered. So, to minimize stock investment risk, you as an investor should evaluate it in the chosen investment. So here are the 6 ways to minimize risk in the stock market. One is do your homework. If you don't have any ideas, it can be challenging to launch a firm at first. This means you need to do your homework on the stocks you want to buy. Watch business related TV, study annual reports and the business section of newspaper, and ask questions. Your broker might be able to provide more details on the aforementioned stocks. By doing your research, you'd be able to avoid trading based just on rumors. Two, diversify your stock investment. The investment should be stretched out, investing money in equities of 5 to 7 different types so that losses in some can be somehow increased in some areas will be more than offset by gains in others, while allowing you to monitor business grow in each. For example, if you have many baskets and you have eggs that need to hatch, spread them out among the baskets rather than placing them all in one. So this way, if one doesn't hatch, the others in the other baskets will. Although the others are hatching, you are less affected because your risk is lower. There is a higher chance of fruitiness if you put all of your eggs in one basket, because if one of them is rotten, the other eggs will be damaged as well. So that's the also in stock. Three is beating the market. When people are most pessimistic, you should buy and then sell. In the most upbeat state, contrarian investing is what it is. It's been a claim that investing in stocks is more about knowing when prices have hit the bottom. In some ways, outperforming the market not only means more money in your account, but also implies you've chosen individual stocks that have outperformed the market. 4. Avoiding trading in market. This means that trading on margin entails borrowing money from a brokerage business to execute deals. When you trade on margin, you put your money at risk despite declining prices. There is a pressure to sell due to a settlement obligation. This implies you could lose a lot more money than you put in. 5 is know when it is advisable to cut losses. As previously stated, cutting losses entails selling even at a loss even at a loss during period of prolonged market decline. Even if you have an intriguing, unique business idea, a clear business strategy, cash reserves, and a passion for your business sector, you may still struggle to gain traction and make a splash in your market. Therefore, knowing to cut your losses and move on is critical. To break even, if a stock falls 1%, it must rise by more than the lower amount. If you wait for the stock to fall by more, you will have to wait until it rises before breaking even. 6. Remain focused on long-term objectives. Stock investment necessitates long-term thinking despite the fact that You can buy and sell based on pricing. Despite price volatility, the majority of the investment must be in stocks, which are projected to increase in the long run. That's the end of the discussion. So here's a quote from billionaire businessman Mark Cuban. The early stages of starting a new business are all about reducing risk and maximizing your success potential skills. He also professes that true business success is found through hard work, leveraging your skills, reducing risk. So thank you for listening and watching my video.